How SALT deductions work post-TCJA. The state and local tax or SALT deduction has long been a valuable tax break for taxpayers who itemize deductions. However, the Tax Cuts and Jobs Act, or TCJA, of 2017 significantly changed how SALT deductions work, placing a cap on what you can deduct, which remains in effect through at least 2025. Here's a breakdown of what you need to know. The SALT deduction allows taxpayers to deduct certain state and local taxes paid during the year, including state and local income taxes or sales taxes. You must choose one, property taxes on real estate, and some personal property taxes like vehicle registration fees based on value. Before TCJA, there was no cap on how much you could deduct, making it especially beneficial for residents in high-tax states like California, New York, and New Jersey. Effective tax year 2018, the TCJA limited the total SALT deduction to $10,000 per year for individuals or $5,000 for married taxpayers filing separately. This cap applies regardless of how much you actually paid in state and local taxes. Alright, so here's an example. Let's say you paid $8,000 in state income tax and $6,000 in property tax. Well, you could only deduct $10,000, even though you actually paid $14,000 in total. High income and high tax state residents have seen a significant reduction in deductible expenses. Married couples filing jointly are especially impacted, as the cap isn't doubled for joint filers. This limitation may result in higher federal tax bills, depending on your total deductions and income level. Some states have tried to minimize the impact of the SALT cap by creating charitable contribution workarounds, largely disallowed by the IRS. They also offer elective pass-through entity or PTE taxes for businesses, letting owners pay state tax at the entity level and bypass the personal SALT cap. These strategies can help business owners reclaim some lost deductions, but they come with complex rules. It's best to consult a tax advisor to see if they apply to your situation. The SALT cap is set to expire after 2025, unless Congress extends it or passes new legislation. There have been repeated efforts to raise or repeal the cap, but as of 2025, no changes have been enacted. Need help navigating SALT deductions? At SK Tax Associates, we stay up to date with tax law changes and can help you make the most of your deductions within the law. Contact us today to see how the SALT cap affects your tax return and what strategies you may be able to use.